We are live. Guys, this is Magic Monday. I'm your host, Tfsa, with the Leadership Wealth podcast. Check it out. And but this is Magic Monday, where we are the wizards of Ontario real estate and investing. And when I say we, who am I talking about? I'm talking about my co-hosts as well. We've got the illustrious Jason Vaz.
How's everyone doing?
Yes. You guys know Jason has always got thoughts for you guys and ways to improve. Now, of course, Jason, who's this other guy that's with us?
Oh, drum roll, please. The man, the myth, the legend, Marlon Ye-Man.
What's up, boys? What's up? Happy Monday.
Guys, if you can't have fun, man, it's time to go home, right? Like, man, I'm so glad to have you guys with me on board and talking about these topics. You guys have anything interesting from the weekend that you guys want to share with us?
Not much. Just
that you can share with us.
Yeah, just did some family stuff. That's about it. Taking care of the parents, getting old. So I heard Jason had a pretty exciting weekend, though.
Uh-oh. Is this going to be rated for TV? Are we allowed to hear?
Yeah, I guess you could hear.
Okay.
Crashed a motorcycle on Saturday. That was so I got a doctor's appointment after this.
Okay.
Just a couple bumps and scrapes, nothing crazy, just more precautionary looking at things. But I was learning how to ride a motorcycle. So it was on the learning course. So it was pretty safe environment, lost control. And caught some air, popped a wheelie and didn't know what to do.
Well, we're glad that you're doing okay, that you're going to go get checked out by the doctor and stuff like that. Glad that it was on a training course and not on the open roads and with other vehicles. But, but guys, if you're watching, can you see this? Can you see this man's commitment to be here, to show up for you, and to talk to you guys here on Magic Mondays? It's amazing.
I think we
lost Neil.
Oh,
there you are.
We got him back. We got him back.
I was gonna say.
Okay. I was just saying thank you there, Jason, for showing up today. So
thank you.
All right.
Thank those for
allowing me to be here today.
Yeah. All right. So guys,
Neil holds me hostage.
Yeah. Lots of interesting things happening. I would love to share with you guys some things that are going on in the investing world, but we will leave that for another show. And today we've got coming up a little later on, Nima Salehi, and he will be talking today about insurance. How you can utilize it to create wealth, how you can utilize it to protect your wealth, how you can utilize it for generational wealth. And, I think we might have a couple of insurance skeptics in the room here, but we're going to look forward to hearing from him in a little bit. So, but before we get there, let's get to Marlon Ye-Man with Marlon's Mortgage Minute.
Yeah, I mean, not much to talk about. I mean, kind of a big deal, though, at the same time. So last Thursday, we saw mortgage rates, specifically fixed mortgage rates, bump up by 0.3, 0.40%. So, a lot of lenders were offering 1.99% on a 5-year fixed. We've seen a lot of those lenders jump up their rates to about 2.34. So the reason this went up is because, 5-year fixed rates are based off the 5-year Canadian bond yield. The yields went up. So to help our viewers understand why do yields go up, specifically this had to do with what we call the U.S. Federal Reserve, which is the equivalent of the Canadian Bank of Canada. So what happened was the U.S. Federal Reserve said they're going to start tapering their bond purchases. So what that means is during COVID, this whole time, the governments have been artificially holding the rates down, and in order to achieve this, they have to buy their own bonds. When you buy the bonds, the price goes up of the bond, but the yield goes down. They've now announced that they're going to start tapering their purchases, meaning cut back their purchases, which had the market kind of, go into a kind of a reactive mode and said, okay, that means yields are going to go up. Everything's going to go up. There's also a lot more talk by the U.S. Federal Reserve that they're more certain than ever that they're going to raise rates starting in 2022. I'm thinking that's going to be early 2022 because they were saying later in 2022. So this could have an effect on the Bank of Canada here. But overall, this caused our 5-year Canadian bond yield to rise as well, which increased rates to rise. Something else that's happening as well is inflation. Wages are going up. And at the same time, this is causing inflation in the market. And supply chains. So, I saw an interesting video over the weekend and it kind of brought to light, a lot of you might have noticed foods going up in the grocery stores and all that stuff. It's even expected to go even higher. Some say 30 to 40%. And the reason for that is, people that supply certain, inputs or food to the grocery stores, they sign contracts at a certain date to, I'll sell you this much at this price. Those contracts are all coming to an end. So, you as someone who's selling something, if it's coming to an end, the prices have gone up for you, you're obviously going to, go with a higher rate on those contracts, higher pricing. And we're probably going to see that come in towards our food and all that stuff. If you guys are into smoked meat, I go to a place called Sumalicious in Scarborough. You guys need to check that out. This thing it's amazing. He used to work at Schwartz in Montreal. But to give you an idea of inflation, I went there a couple of days ago, and there's a sign saying, really sorry customers, but we had to raise our prices in order to keep the business open. This sandwich normally costs $11. It's now $14. So, that's a big increase on a sandwich, So, I mean, you can definitely see the inflation coming in different areas in our lives. And, as our viewers, you should be aware of what inflation is and how it's going to affect you. And, if you have money out there sitting in a bank account, you're not doing yourself a favor. You need to invest that money to keep up with the cost of living of inflation. Hand it over to Neil.
Absolutely. Thank you very much. Jason, can you say something with regards to the raising of the mortgage rates and what you think how that might impact real estate prices, which is home prices, that is?
Well, Marlon, feel free to jump in here and correct me if I'm wrong, but last I checked, before this rate increase, we saw a rate decrease of about 0.2%, and now we see it going up by 0.4%. So net, we're really only above by 0.2%. It's not enough to shake people away. It's not enough to scare people. We know that overnight lending is pretty much going to stay pretty stable until the end of 2022. So I don't think this is. I think the real estate market is going to be how it's going to be in one mode from now until the end of 2022, and that is extremely hot. Now, in regards to the entire country, we might see some changes, but I think in Ontario, specifically the Golden Horseshoe area, GTA area, I think we're just going to see record-breaking prices month after month. Everyone asks, is this sustainable? I don't know. With the cost of goods going up, wages are going up as well. There's more job growth. People can afford more than they could last year. So is it too crazy to assume that prices of homes are going up? I don't think so. So yeah, I don't think these nominal rate increases are going to affect prices in real estate. I think we're still going to see massive growth.
Yeah. Well, I can say from the investment standpoint that anywhere across the country where there is a demand, where there's jobs, there's going to be demand for housing. And we know that the shortages across the country for that matter. And so it's really, you may see it in the secondary and tertiary markets. They may start to ease out a little bit, but for the most part, our main markets across the country, I would say, there's just too much demand. We don't even have the inventory. And I think you've touched on this before, Jason. Now, I just want to do one little thing here, Jason, because this is something that came out of sort of the election. And Wyatt, do we have that video? I want to get Jason's feedback on this video. This is a blind reveal, by the way. So let's see. Let's see if we
your
can
only
get this.
communication is the buyer agent, right? So now your buyer agent ask you to sign the offer document, and he takes it inside, and he comes back after 5 minutes and saying, oh, there's a better offer somebody offered, we need to up our price. So you put, okay, let's put 10,000 or 50,000 or 100,000, and then you sign the document again and you send him the messenger, and he goes in and comes back again and saying, no, there's even somebody putting even a higher offer. And you sitting outside, you see that other people are going in and coming out, right? What's really happening is the seller agent has his own buddies or his own henchmen sitting outside, just like you, pretending to be customer.
So here's a guy talking about blind bidding and talking about what's really going on behind the scenes. And Jason Vaz, your response.
So he's not talking about blind bidding. He's talking about phantom offers. So what phantom
well, he was actually talking about blind bidding just before that.
Yeah, no, but what he
the
was
reason for
what
transparency.
The truth is that it's all phantom offers.
Yeah.
It's not the case. Do phantom offers happen? Of course. The reality of it all is there is some safeguards in place. For any of you that have purchased a home, you have signed off a piece of paper. It's the first form. It's called Form 801. What that says is it doesn't say your price, but it'll say the agent's name and the two buyers' name. If there's two, if there's three, how many buyers are putting in. So for example, every offer I put in, say I'm representing Neil and Marlon, they want to buy an investment property. Before I put the offer in, I have to get them to sign a Form 801. It's going to say Neil D'Souza. It's going to say Marlon Yee instructed Jason Vaz to put an offer in at 8 p.m. via email. They have to sign off on that. Then when we put it through. Now, the reason we do that is that if we're in a multiple offer scenario, anyone who's involved in that can request the Form 801s from the other people. Now, obviously, can they go get their buddies to get fictitious buyers and all that? I'm like, yeah, but it does add a layer of protection. You got to get a lot of people in on it. It's not a bunch of agents, powwowing and making up some nonsense. Could they put fake names? Of course. Again, that's fraudulent. Putting in a fraudulent offer, it's a risky game, because imagine, if you will, if you're my seller and say that's my strategy. I say to you, hey, we've only got one real offer, but I've got 3 of my buddies that'll put in fake offers, and we'll get this one real guy to put his offer up. What if that one real offer gets fed up and pulls? I'm left with nothing. It's not worth it. Most agents know that. That's kind of how it works. So, and in this market, like, we're not looking at 2-3 people coming out on a house. Like, I was in multiples last week and we were one of 37. I highly doubt anyone has the time. If you're a seller agent, you don't have the time to play that nonsense. There's enough offers out there. You don't need to make fake ones. So I can see why people are thinking that. It sounded like that guy was from Brampton. It's quite common there. It's the Wild West. Brampton, I've probably seen it the most. It's the only place I've actually seen it happen. I don't practice there for a reason.
Jason Vaz with Reality Real Estate right there, guys. All right. Listen, without further ado, Jason, thank you so much for that, by the way. Without further ado, let's bring in the man he's going to be talking to us about. As he's a financial advisor, he does both financial and insurance advising, and he is going to share with us some of the basics when it comes to insurance for creating and protecting your wealth. Let me bring in Nima. Nima, are you there? There we go.
Yes.
Hello, welcome.
Good morning, Neil. Good morning. Happy Mondays, guys. Magic Monday.
Yes. No, it's Magic Monday. It's magical. That makes us all happy. So glad to have you on, and we're glad to kind of talk about this topic. We don't talk about insurance very often, but we're really talking here about specifically life insurance, correct?
That is correct.
Okay, great. And now, I've heard this before where people talk about how you can kind of be the bank when it comes to insurance, but there's not a lot of clarity when we hear topics like this, when we hear about creating wealth or protect. I mean, we understand to a certain degree about protecting wealth with insurance. But can you give us sort of a basis of, first of all, where you come from in this industry, where it interacts between insurance and financial advice? Can you just start giving us something there to begin our conversation?
Yes, absolutely, Neil. I would go one step back towards what you guys are doing about real estate. And whenever you want to close a mortgage or sign a deal for a property, the financial system, as the last check and balances, they ask for a simple insurance binder for that property. Yeah.
Yep.
So that's tie, it's right there. They ask the insurance guys, what do you think about this? So similarly, you can extend the same analogy to the rest of this conversation. That financial system always rely on the insurance part in order to make sure what they have in the game is protected. It's guaranteed. If something happens, nothing is going to be become at risk from the financial point of view. So that's a kind of underlying tie, Neil, underneath that. Let me pause and see if I managed to put the point across with you.
Yeah, no, that's great. You're right. It definitely we whether it's title insurance, whether it's home insurance, insurance definitely crosses, including Canadian Mortgage and Housing Corporation, which of course does mortgage insurance as well. So yeah, absolutely.
Good. Now you brought up two key points, keywords at the beginning of this talk. You used the two words side by side. Can you repeat those two words again?
Ooh,
generational,
creating and protecting and
generational wealth.
Generational wealth. Yes.
Can we start from here?
I love it. Let's start from there.
Yeah, let's go for it. So first of all, we are talking about wealth. And we use the word generational prior to that, to just make sure that we understand the context of that wealth. It has to be generational. I'm not a selfish person here that I'm trying to make some money for myself. I'm trying to create a wealth and pass it to the next generation. Is that the right understanding of the phrase?
Yes.
Yep.
Yeah.
Typically, yeah. Good. Now, in order to create wealth and protect it, what are our means to create wealth? You mentioned that there are notions out there or perception out there that basically tries to use life insurance policies as a source of equity, source of investment. You mentioned that become your own bank. How can I become my own bank by using an insurance policy?
Tell us.
What banks like to do?
They like to lend money.
They want to lend money. At the very same time, they want to avoid losing money. Yes?
Yes.
They want to make sure that it's absolutely protected. That brings us to that word protection. Whenever you want to talk about a loan, whenever you want to talk about an investment, besides the fact that we are lending, there is a risk involved. And that risk in the equity market, in the stock market, it's all there. There is one product out there in the financial system that the whole foundation of this system is built upon that. It's insurance, the life insurance that can never fail. It's always guaranteed, and it's always there no matter what. Now, if you want to become your own bank, you have to make sure that you have that protection with you. Because if you want to get money out of your bank, the bank has to make sure that if something happens to you, if something happens to Nima as a person, there would be enough money to cover that loan. So that's a kind of a tie between insurance and wealth and being your own bank. That level of protection, guaranteed investment, that guaranteed word, that's always there. Let me pause here, guys.
Nima, I absolutely love it. But I think what some of our viewers would be very interested in is, like, we look at insurance, and a lot of us are novices. Some of like I myself, I've got a couple of policies which you and I have discussed.
Yeah.
But where other people on is they look at insurance as almost like a thing you have to get to make sure you can drive your car, you know?
Yes.
And they look at it as like you don't really benefit from it because, for most of us, when we look at car insurance, there's a deductible, you're paying a couple $100 a month. And then when you meet in an accident, you got to pay a couple thousand. So you're always paying, and then they cover the rest.
Yeah.
Well, life insurance is a little different because you can have a clean driving record and never get into an accident, never really touch that insurance.
Yeah.
But with whole life, unless you're a vampire, unless you guys are all telling me something that I don't know, we're all going to die at some day.
Yeah.
And that's where that guarantee comes from.
Yeah.
And the idea is you are able to put that money into the pockets of your descendants. And not just that, Nima, you can expand more on this. With a full life policy, you can actually borrow against the policy while you're still alive. And there is a bit of a tax haven there. So I'd love for you to maybe jump in on that because I think our viewers would find that extremely interesting on, when we're talking about pulling out money, when we're talking about making money, one of the biggest questions that gets thrown out is, what are the tax implications? So let's create a scenario. Jason here meets up with Nima 10 years ago, and I took a $1 million policy with you, Nima.
Yep.
Now Jason wants to help his kids' college fund, wants to buy a house for his children, something of that nature. What do I do?
If you got a $1 million whole life policy 10 years ago,
Yeah.
beautiful. The value of that policy, has it stayed the same, Jason, since you got that whole life policy?
I know the answer, but I don't know. You would say it has not stayed the same.
Has not stayed the same. Whole life policy is perhaps the only and universal policy with that token. Perhaps they are the only financial tools, life insurance tools, that their value increases over time. There is equity that is built within that. There is a cash value, that's what they call it. The cash value that it's built within that, the dividend that it generates, allows that the value of that policy to grow over time. So, by the way, the technical term that it's used out there for a whole life policy is participating whole life. That's a technical term.
Okay.
A pool of money that comes into together and would be invested and basically becomes the foundation of that equity that can allow us later on to leverage it towards basically buying a property or making any business investment, if you will, or personal investment, if you will.
Mm-hmm.
It's a leverageable asset to a sense. From practical terms and from technical terms, it can act as a collateral. Yeah. So if I'm on the receiving side of it, it becomes a leverageable asset to me. If I'm on the lending side of it, I know that there is a whole life policy that can act as a guarantee that this loan will be always fulfilled, even if Nima is no longer around.
Mm-hmm. So Nima, for our viewers, what are the tax implications of that? So again, I have this $1 million, say it's gone up to 1.2. What are the tax implications if I want to touch that money while I'm still alive?
Let's talk about tax and put it into a little bit more a specific context. Are we talking about tax exempted or tax exemption?
I don't know. You tell me. Like I say, like my cashable amount is 200,000. I want the 200,000. Is there a holdback? Does it go reported? Do I put 200,000 now on my income tax for 2022? How does it work?
Can be a step back for a second. What are the tax exempted financial tools that you all know? There are a handful of them.
So we've got TFSAs.
Yeah.
We've got
RSPs.
Sorry?
RSPs.
Yeah. We've got property. This primary residence is a tax exemption.
VERAs. Locked in RSP accounts.
Yeah.
Yeah. Those are the three I can think of.
Good. So let's first go to the first one, RRSP.
Mm-hmm.
It's a tax. Is it a tax exempted tool or is it a tax deferred tool?
Tax deferred.
Tax deferred. So we can simply cross that, put that aside. It ain't gonna help us. TFSA, it's tax exempted on the capital gain that we make.
Correct.
Yes?
Correct.
What is the drawback of a TFSA account? There is a
There's a cap on how much you can put in.
Absolutely. There is a cap on how much you can put in.
Mm-hmm.
So after a short while, you would be maximizing your TFSA, and then you would be almost left with no other tool to make capital gain tax exempted investments.
Mm-hmm.
Is that a fair statement?
That's fair.
That's fair. Good. Now it becomes to life insurance policies. Whole life insurance policies, within them, right in the core of that, allows a tax exempted equity build and growth. It allows us to build equity and cash value, because the money that you would invest in that whole life policy would be invested by the insurance companies into the all different diversified assets, and brings back a certain rate of return, and the money gets back into your account. Now that capital gain right there, it's tax exempted.
Okay.
But can you tell me what is the ceiling of that? What is that cap that we had in TFSA?
Is it 85 or 70? Did it get increased to 85? Last I checked, it was 75.
That was 75 or 85. That's for TFSA.
Around there, yeah.
What is your understanding or guess about the amount of tax exempted capital gain that you can make in a whole life policy? What is that cap?
I don't know. I didn't know there was one.
I would think it's you can make as much as you want in a whole life policy in the cash value side.
Absolutely, Marlon.
Yeah.
It depends on your net worth. Based on your net worth, you go and say that based on this network insurance company, based on my cash flow, based on my financial needs, I need this amount of life insurance policy. And that amount of life insurance policy, it gives you a very decent, hefty, tax exempted capital gain bucket. Now I grow, my net worth grows, my cash flow grows. I can go back to the same insurance company and say that I've grown. I now own more. Can I borrow? Can I have more room in my capital gain tax exempted vehicle?
When you're saying capital exempt, you're talking, just for viewers, you're talking about the death benefit of the policy, right? You're talking about if they pass away, this is what comes out, gets paid out to the families. Or are you talking about the cash surrender value?
Fantastic. So let's talk about the tax exempted capital gain that comes out of that policy. Yeah,
Yep.
that's the first major benefit of that. That is going to tie back to the word that Neil put at the beginning of this, generational. That tax exempted capital gain is going to make the generational wealth keyword meaningful. It makes it possible, because now you got as much as you possibly want, and as much as your network allows you, or your financial underwriters allows you to have capital gain tax exempted gain out of your life, in order to make sure at the end of my life, that asset that I've developed and built can be passed to my next generation.
Mm-hmm.
Yeah. Have I addressed your question, Marlon, right? Did I understand it?
Yeah, I think so. Is that the death benefit you're talking about, though?
That's the death benefit, yes.
That's the death benefit, right?
My apologies, yes.
Because whole life has two parts, right? There's the amount you're insured for, and then the extra money that you're putting in your policy goes into the equity side of the mutual funds or segregated funds that builds up other stuff for you to leverage in the future.
Absolutely.
Right.
Let's recap what just Marlon brought up. The death benefit of a whole life policy allows us to have capital gain tax exempted money, insurance death benefit. Yeah.
Yep.
That's the investment that we made. That's the outcome of that. Now,
Right.
you also, Marlon, touched on something, that there is a capital gain out there, but it can be used as a leverage, or we can get a loan out of that. Have I understand the second part of that question right?
Yep. Correct.
Yeah. Good. Now, the equity that we have in the whole life policy can certainly be leveraged or used as long as it exists, and as long as it's in a decent size, and it needs time to grow to that level. But it can be used in order to receive loans from the financial system. and act like a collateral. Basically, I've invested my money, or you invested your money in a whole life policy, and there would be equity or cash value that it's built within that policy. Now there would be a time that I need to make an investment. I want to buy a property, real estate investment property. And I believe that I need a little bit of extra cash, or I want to start a business. I'm an entrepreneur and I want to start a business. Different use cases can be out there. It's up to us to how to use this. But then we can go to the financial system and say that I do have this whole life policy in my hand. Here is the amount of the cash value. It's within the policy. Can I borrow against that cash value?
Of course.
And, yeah, go ahead, Jason.
Yeah, of course you can. And just so our viewers quietly understand here is that what Nima is referring to is, and a lot of people where they've misinterpreted is that they think you only benefit from an insurance policy is when you die. That's not the truth. With a full life policy, you can borrow against that. And when it's a policy where, say, you take out $1 million and it's invested and it grows, it'll most likely go in the ballpark. And Nima, you can correct me if I'm wrong. You know, $1 million we're looking for the duration of your life could be touching closer to 4 million. You know, if you get a policy at around 27 years old, and if you live up until 80, by 80, you're looking at about $4 million. And the cost associated with that would be about 200,000 for a smoker, 100,000 for a non-smoker. Are my numbers right?
I would. Your numbers depends on the use cases. There are a lot of ways that you can design a whole life policy.
Yes.
For a particular design, your numbers might be bang on. Yes.
Yeah. So that, and I'm just using my own policy just to kind of think about how it was done.
Yeah.
But the point is that once you've paid that off, and once that investment's grown, every year you get a piece of paper to show you what your cashable amount is. Now, yes. I can use an example. I have clients that use that to purchase their first home. In the early 20s, they went and got themselves a full life policy. Now they were touching about 28, 30. And at that time, they'd paid so much into it, they were able to pull some money out and help them execute a purchase. I think it's a phenomenal tool. And when we were talking about the tax implications is that they don't have to pay back that loan. They just pull the money out and use it as they please. They use it as cash, which you're borrowing against the where that money was invested in. I think it's a phenomenal tool. I think more and more people need to be using it because the reality is you don't have to wait till you die. We're not paying our kids. You can use this in your own life. You can, and
who knew insurance could be so interesting? I'm sure Nima did, of course. Nima, we've unfortunately reached our time. Can you give us some final thoughts here first, and then I do want to be able to give you a moment to let people know how they can get in contact with you. But can you give any final thoughts here on insurance and its place in generational wealth or creating? You've given us a lot to think about, but can you kind of close off our thoughts here?
Absolutely, Neil. Basically, the immediate value of a life insurance is protection. If you have a mortgage insurance or a term insurance, that the immediate value is right there. Either of those two, they're going to protect your family and protect your asset and loved ones, period. Now, if you want to think beyond that, if you want to now say that my home is going to be paid off, my family is going to become debt-free if I pass away. Now, if you want to go beyond that, there are fantastic financial tools, tax-exempted financial tools within the whole life policy that allows you to the proportional of the wealth that you want to create, to invest in that life policy, and allows you to pass that to the next generation. So it's a flow that it goes all together. It's a start from protection. That protection assures us that everything is in place if I'm no longer around. With the same token, the financial system is going to trust you, that if you're no longer around, the debt is going to be paid, and it allows you to borrow. It allows you to leverage the cash that is in the policy, and then it's proportional to what you want to create at the end on the generational wealth and pass it to the next generation.
Mm-hmm. Wow. Well, Nima, I think this is definitely a conversation that we need to continue. We're going to have you back on. But if someone wants to get more insight about life insurance and where it fits in, how do they get a hold of you?
Any of the ways of communication on LinkedIn, Facebook, Instagram, I'm always there. Come to Neil and ask for Neil or Jason or Marlon. I'm going to be always in touch with the guys. And at the same time, I would encourage everyone to spend some time and dig into it and learn about it. There's a lot of good literature out there that you can go and find those out. If not, drop me a note, and I will definitely be more than happy to have a conversation about it with you guys.
Love it.
Fantastic.
Love it.
It was a pleasure having you, man.
Thank you.
For all our viewers, guys, if you haven't already, make sure you get yourself a policy. It is definitely the right thing to do. I'm a huge advocate for this.
Thanks for having me.
Yes, thank you so much. Well, guys, this is Magic Monday, another episode. Now, quick note, next week is Thanksgiving, so we will not be with you. We will be doing the turkey thing. And we will not be seeing you next week, Monday, but we will see you again the week after. So thank you guys so much, and have yourselves a great Thanksgiving. On behalf of Nima and my co-host, Jason Vaz, Marlon Yee, thank you guys so much for tuning in to another episode of Magic Mondays, Wizards of Ontario Real Estate Investing. Take care.
Till next week, guys.
Bye. Take care. Till week after next.
Yes.
Waiting.
You're still going.
Bueller.
I love this show. You guys are too funny.
It's great. Do you guys have any plans for Thanksgiving?
Yeah. We're still live, by the way, guys. Let's just put that.
That's great. Hey guys, why don't you
X-rated
join us
plans.
for our
No
Thanksgiving
X-rated
plans?
I'm going off to the cottage.
Nice.
Gonna do some fishing. Gonna eat some food. I was actually just chatting with my cousins this morning about everyone's got a day where they've got their meal.
Yeah.
We're trying to figure out what we got to cook.
What day are you fishing?
Good, but we want to make sure we're not putting too much effort because it's time to relax.
What day are you fishing?
Every day.
Oh yeah, can I come up for a fishing trip?
Sure.
I just come
Fish
fishing
off the
in
dock.
front.
It's not that great.
Oh, it's off the dock.
We
Okay.
just cast off the dock, dude. I just sit there and drink beer, man.
Well, guys, I thought that.
Why we're having technical issues? We are stuck here.
Let me guys ask you this question, since we're in overtime right now, but we just brought up this topic of insurance with regards to exemption versus deferral. Do you guys have any thoughts on that?
Yeah, I want to make it clear, like, guys, RSPs are great tools, and I know they're really pushed hard by banks. I find that RSPs are great because it reduces your tax. So let's say make $100,000, you'll be allocated $17,000 that year to put into an RSP. And what it does is it reduces your taxable income by $17,000. That's fantastic for right now. The problem is that when you need to draw out that money when you retire, and so you take out $17,000, that is what you're going to be taxed at that rate.
A lower tax rate because you'll be retired at that point.
That theoretically, yes, but I want people to understand as well. Historically, we are paying the lowest amount of taxes in the country's history. So the likelihood is the tax rate will be higher then. So I am not a huge advocate for RSPs. I don't believe in them. However, life insurance, I'm a big advocate for. Why? Because you pay nothing. You don't pay them a dime. You know what you do? And most policies, which Nima didn't get to tell you, is that most policies, if you live to a certain age, they just give you the money. I think it's 100 or something like that, though.
So as you know, I'm a financial advisor, and I was trying to be, keep my opinions to myself, be impartial. So, there's life insurance out there. Life insurance is basically an umbrella of products. Just like in mortgages, we have reverse mortgage, we have private lending, we have A mortgages and B mortgage. It's not all, it depends on your situation. Whole life is a great tool for building generational wealth. But for the majority of people out there that just need life insurance, term is the best. You can So what he failed to cover is that whole life is typically 3 times more expensive than term life
It is.
insurance.
Yeah, a
And
little
that's
bit more,
because
actually. A little bit
so
more.
it's extremely expensive. So to even get a $1 million policy, I'm telling you right now, is impossible for most of the population.
Most of it's going to cost like $2,000. If you are a
I'm not putting
smoker,
$2,000 on life insurance.
$1 million life insurance is going to cost you It's going to cost you $2,000 a month. Like $1,900 a month.
So for viewers who are still with us, to give you a simple breakdown of how whole life works is, if it's 2,000, basically your insurance really is probably maybe $500. $1,500 is going into investments inside the policy.
Yeah.
Those policy, they invest it. The bad part is you don't get to choose your investments. Yes. Number 2, you say you can leverage these investments, i.e. borrow. If you look at it this way, you're borrowing your own money. I don't know why you'd want to borrow your own money.
Well, no, it's
because
not
you
so
put
much
that money in there.
Borrowing your own money. So, now, this is what you got to understand here.
No. Read the contract. You're going to borrow at a rate.
Borrowing against your house. Many people
No, but
do.
Jason, if you just bought term insurance for $500 and invested $1,500 a month the way you wanted to,
that's true.
You would still have the money. So why do I need to borrow my own money out of a policy? I'm not saying it's a bad thing. It works for the wealthy. It works very well because they already have lots of money anyway. Yeah. This is something there. If their kid needs something or they need some extra funds, they just borrow against the policy.
So I'll pose this a little bit differently for people. Yeah. And this is what I would suggest people do. Scrape your RSPs. I don't think it's a good vehicle for some, but I think if we're thinking on a higher level of wealth, there's a way you can reorganize this. And this is how you really use the generational side of it. Is you open up a trust. So every time you have a child, you start a full life right away. The money that you would put towards their college fund, put towards that. Because the reality is they're probably going to go to college by the year 20. And by that point, you would have already paid off the thing. You have to remember that full life, they only take 20% of the policy. So if your kid's obviously a non-smoker when they're born, so you're going to pay a very low rate. So for $1 million, you might pay $1,000 a month. You throw $1,000 a month in there, you'll pay about $100,000, and effectively once you've hit that $100,000, you no longer have to pay into that policy. But this is where you get things a little crazier: is that you don't make, obviously the kid has no benefactors, you make a trust the benefactor. And what this does is it allows them to put it into a trust. They can draw from it however you want to construct it. Or if your kid's successful and doesn't need that money, when they have kids, they do the same thing. And they use the trust as their bank. That's the idea of building the bank. The trust becomes your bank.
So that idea I'm okay with, buying it for your kid. But again, not average person cannot afford to do that for their kid. And
you're right. You're absolutely correct that it does come down to affordability.
Yeah, it's affordability. It's more of a product for, the upper middle class, more wealthy individuals, more savvy individuals. For the average person, their term life insurance is more than sufficient. They can use the other funds. The other thing I just want to make clear about whole life is that, you have your death benefit, which means you're insured for $1 million. What happens is the investments grows over time. When you die, your kid does not get to choose both. You either choose the $1 million or you choose the value of the investments. Mm-hmm. So obviously you're going to choose whichever is higher. So let's just say the death benefit is higher. Let's say this is only worth $800,000. Your death benefit is $1 million. You're obviously going to take the $1 million. What do you think happens to that $800,000? It actually goes back to the insurance company.
Oh, okay.
You don't get it. So that's one of my peeves with whole life. So that's why I recommend term for the average person. But I'm not saying there's no place for whole life. There's some people it makes total sense. It depends on, like I said, it's like an umbrella of products. Whole life, universal life, life insurance, mortgage insurance, all that stuff. It's just up to the person to figure out.
I think the only people losing.
Wait, hang on, Jason. Just before you jump in, let me just say for those of you that are still watching, I'm going to throw in a quick disclaimer. None of this is meant to be financial advice specific to you. Please make sure that you get tailored advice based on your situation. These are great topics to really bring up your awareness and IQ on these topics. So
I think this is
just want you guys to know. All right, Jason, go ahead, jump in.
Yeah, this is a calling card. The disclaimer is that this is a calling card that, it's not advice. What it is it's a calling card to say, hey, call an insurance broker and have this chat. Because if you take what we say, what I'm saying right now, and go and sign up a policy, you're pretty stupid. But if you see this and you don't call a broker and have this discussion, you're really stupid. Don't be really stupid. Our viewers aren't stupid. Our viewers are very smart. But anyway, to kind of talk on what Marlon is saying here, I should say here because that's what he's. I believe in a hybrid model, so I have both. I believe in grabbing term insurance to insure assets. So, for example, guys, when I bought my property, the house that I live in, I signed up for a 30-year mortgage. So what did I did? I called my broker and I got myself a 30-year term insurance for the value of what I projected my house would be. All right. Doesn't cost very much. You're right. Term is very cheap. Why? Because when that 30-year comes and if my heart is still beating, it evaporates and all that money goes away. But what I'm ensuring is that if I die, I don't leave any debts to anyone. None of my benefactors are going to be in any trouble whatsoever. The reality is I'm not going to die tomorrow. I'm probably going to die later on in life. All
You
right.
almost died over the weekend, bro.
I did almost die over the weekend, but I had insurance. And just a quick shout out. If my sister is watching, she would have been a very wealthy individual had I died this week. So obviously you don't have kids. You put your siblings on.
So now your sister can't kill you because it's public knowledge that she's the beneficiary. So
she could still joke about it, which she does. It's a common joke that we have in our family. But yeah, no, I genuinely feel like, guys, you should be doing this. The reason being is, and Marlon, you've seen this, every time somebody goes to get a mortgage, the first thing the bank does or the lender does is call them up to get mortgage insurance, which is a completely different product. That's insuring the balance of your mortgage while the term is actually insuring a fixed amount. So if you buy $1 million house, you put $200,000 down, you have an $800,000 mortgage. Mortgage insurance will insure the 800. That amount gets smaller and smaller every year. Every payment you make, you're bringing that principal down. While term insurance for $1 million will always be $1 million. So if anything happens to you, $1 million comes your way.
Yeah. So just a quick tidbit for our people out there. You know, no matter what, once you get a mortgage, you need to get some form of insurance. Okay. Mortgage insurance is not the best product to get out there. And there's a couple of reasons for that. The main one being that your family is not the benefactor of that insurance. When you pass away, that money goes solely to pay off the mortgage. That's it. So your people get nothing. As well, you know, you're usually covered for the mortgage amount at the time of your death, but your premiums stay the same over the life of your payments. So you're overpaying for insurance at that point as well, right? And the other thing is a lot of these mortgage insurance policies are not fully underwritten up front. So a lot of them do not end up being funded when you do pass away due to you failing to disclose things that you weren't aware that you need to disclose.
Yeah.
So, I mean, you're better off getting term life insurance, whole life insurance, universal, but you must get some form of insurance if you're going to have a $500,000 to $800,000 loan. Your debt does not die with you. A lot of people think your debt dies with you. It does not. They will come knock into your closest relative and say, hey, you owe us this money. So, you know, do yourself a favor, speak to an insurance expert and, you know, get some insurance.
And you can't declare bankruptcy when your heart stops. You can't follow paperwork.
The different kind of bankruptcy.
So I have to tell you guys, there's been such an overwhelming demand that on the system right now that they will not let us shut down the live today because so many people are excited about this news and what we're sharing here, and so they're getting kickback on that. So unfortunately, for those of you that are watching, I know that you want to hear more about this. I know that you guys want to get more of Jason Vaz and Marlon Yeeman, but really, on behalf of Magic Monday, we really got to let you guys go, and we thank you so much for joining us again. Remember, next week is Thanksgiving, so gobble gobble, and we will see you guys the week after. And we're gonna sign off and we're gonna head out. So you guys take care. Have a great week.
Later, boys. Bye.
Well, now it's just me, all alone.